TheoTRADE. This is Don Kaufman. It's September 15th, 2024. Doing the TheoTRADE weekend update here on a Sunday morning. The calm before the Fed. Look, let's jump right into it here on this TheoTRADE weekend update. I think everybody is aware that what is likely to be the first rate cut, which anywhere from 25 to 50 basis points. We'll talk about that in just a moment. That's coming, and it's coming this week. So once again, enter the Fed. But before we even start talking about the Fed and what I call the calm before the Fed, you got to look at the SPX, the S&Ps, the the SPOOs, whatever does it for you. Look, we have right now some rather unruly markets. And I call this kind of an unruly market, and it's all based on expected move. Now, let me explain exactly what I mean kind of in context here. So each and every week, we look at an options marketplace, in this case, specifically the SPX, for what the options marketplace, and this is, for the most part, the biggest notional value marketplace in the world, and that is in the SPX options. We start looking at the SPX options, and you go just a few days out, and the volume, the open interest in here is just nothing less than phenomenal. I mean, there's literally billions of dollars traded on either side of this marketplace. And we take that option marketplace to handicap, ultimately, forward risk. I'll just give you a quick example. This coming week of trade, we have basically $100 anticipation of movement. Now, that's $100 to the upside and or $100 to the downside. And it's roughly, a $100 move. And again, that's plus or minus. And that $100 move, that's not based on, something, technical analysis or anything. It's literally based, on the options marketplace. Which options marketplace specifically I'm looking at is the September 20th expirations, the PM. Again, the PM settlement. You can see the expected move over to the right-hand side of the screen. That is kind of an average out expected move. It's basically $100. So why start with that? Why do I call this an unruly marketplace? Because the option marketplace, and again, basically the largest option marketplace in the world, has been getting it wrong lately. And not just a little bit wrong, substantially wrong. Look at the sheer magnitude of the breaches in the SPX, albeit the second one is small. Right there, that is a 3 standard deviation move to the downside. This last week of trade, of course, just ending on Friday, again, another significant breach. Now, when you start thinking about expected move is a 1 standard deviation kind of interpretation, of movement. And that basically says, well, we're supposed to be at the end of the week inside of these 3 lines. And why do I draw 3 lines? Look, this is where the week starts, This is the upper edge and the lower edge of the expected move. So for the most part, it's just like a distribution curve kind of flipped on its side, right? And you're supposed to stay in that range 68% of the time. But the reality is the options marketplace right now, again, the SPX, it's getting it wrong, and it's horrifically wrong. It's like the marketplace is just getting ripped apart, that the anticipation of movement, is not nearly as big, anticipation being the options marketplace, right? Because the options marketplace is already handicapping, well, what's going to happen 5 days from now? It's getting it wrong. And it's a critical place to actually start the discussion coming into this Fed announcement. Now, that doesn't necessarily mean the Fed's going to do anything, wild or unruly, but it does tell you a lot about the short duration, and the short duration options. The bottom line, in the short duration, that's, week to week, the market is moving substantially more, than the options marketplace is giving it credit for. And what that actually implies right in the short duration, you'd be a buyer, short duration, like, any of these like dailies, there's a Monday expiration, Tuesday expiration. I mean, this week you even have an AM Friday and a PM Friday. It means net, you probably want to be a buyer of these. Now, of course, it's a couple of weeks in a row over here. Yeah, but we have substantial evidence that show when we start breaching expected moves, we continue to actually breach expected moves. So it's just implied volatility kind of expanding and contracting, and it's pretty interesting actually to look. Again, it's not just that I'm looking at, oh, we're breaching through the expected move. It's the significance of it. I mean, this last week of trade, we literally moved from, let's just roughly put it at 5,400 to 5,600. You know, you got to recognize right here, it's over a 200-point S&P move. Now, this last week of trade, we were expecting about a $128 move. We didn't get quite, twice that, but when you're expecting a $128 move and it shatters through it, yeah, it's a little shocking. It is a little shocking, and that's why I kind of wanted to start this with some unruly markets. And you need to be aware because at forward risk, we often look at like expected move to kind of handicap forward risk, and the expected moves are just, they're not getting it right. And that's the starting place for this week. That's when you have to sit back and go, well, kind of expect anything, right? Define your risk where you can define your risk. Keep your allocations relatively under control, and well, your hands and feet inside of the vehicle at all times, because it's still going to be wild out there. Now, there might be a little bit of calm before the Fed, okay, but our market's really calming down even late in the week over here. Inside of the S&Ps, I'm actually going to take you into right now a 30-day 1 hour. All we've done is basically come kind of full circle. So we had an incredibly tight range for a fairly substantiated period, okay, inside of, and I'm drawing right now in August, okay, we're back right there. So the S&P has dropped precipitously over 250 points. All right, this last week we just ripped right back to the upside. So chicken's done. We are actually very close to all-time highs, no question about it. We're near all-time highs here, but right now, okay, we reside right at, again, about 56 and change. This, I wouldn't say is a critical or important area inside of the S&Ps. It's an area, though, that the marketplace is unequivocally comfortable with. How do you know that? When you substantiate a level for a period of time, like 5,600 or 5,611, you substantiate it for a period of time, you build open interest on those levels, and that is in the options marketplace. And for those of you not aware of this, that options marketplace, people, that's what's the driver of the entire marketplace right now. Well, that and NVIDIA, but that's one of the the key drivers is the open interest, the volume in the options, that it's actually moving marketplaces substantially. So when I say people can dig into this all they want, somewhere around this 5,600, bottom line, because we sat there for such a long period of time that we accumulated large kind of amounts of open interest. And that's also one of the reasons I'm kind of calling this the calm before the Fed. We're in a calm spot right now. We're in a calm spot. There's no question you can move because there's going to be catalysts throughout the course of the week, but the Fed is the primary catalyst in this week. So that's unruly markets. And be aware, again, things can get that much more wild. Now, let's talk a little bit about sectors driving the markets. As I was alluding to a moment ago, okay, NVIDIA right now has kind of become its own sector. NVIDIA still basically up almost 150%, but the rally this week, nothing less than driving the entire marketplace. I mean, if you really want to know, what was your marketplace? And of course, people are going to, well, this stock and that stock. Look, the bottom line, okay, the very bottom line is, it was NVIDIA. You can take a look at Microsoft. In fact, we'll pull up auto expected moves. Microsoft shattered the expected move to the upside. There's no question about it. I don't want to diminish that, okay? But NVIDIA is really the primary driver in here. What is interesting, though, is there's a little bit of defection in the ranks in terms of tech. Apple barely moved on the week, okay? Amazon, another wild bid to the upside, okay? Google came in late in the week, but definitely cracked the upside of the expected move. Meta, very similar, Kate. Some of the price action inside of a Google, yes, to the upside, but nothing too stellar out there. Last but definitely not least, Tesla. Again, nothing too stellar. So for the most part, it's NVIDIA with a side order of Microsoft. If anything, Apple almost like holding back a little bit in the marketplace. So you have, again, tech that was the driver. What do other sectors look like? And this is what is, for the most part, kind of shocking. You start looking at something like the financials. The financials, ended the week for the most part massively unchanged. I mean, it's just there was nothing going on in the financials. The energy sector on the week actually finished slightly down. I mean, look, just time out. You just had a week, and this is why I kind of call it unruly as well. But you have a week where you smash the upside of an expected move. Okay, and you really got to have respect for some of the moves you see on the screen. But you have a week where you smash the upside of the expected move this much, and you have financials and energy. They're not even included. They didn't count for nothing that happened in this last week of trade, and that's why I say in Nvidia. All right, you got me. Microsoft's in there as well. So be mindful of that. It's tech and nothing but tech at this point, which leaves us in. And again, if you're kind of curious, some of the other sectors. First of all, do they really matter? But some of the other sectors in here, you did have some of the consumer staples actually breach again, which is we'll actually cruise over to XLP. I don't want to diminish all the sectors, but nothing to the extent of what we have just seen inside of some of the major tech stocks, specifically, again, NVIDIA on a rip back. All right, let's talk just briefly about the Fed. Look, the probability right now, and what most people expect, is a 25 basis point cut. I don't want to prognosticate too much on the Fed. I would say that the guidance forward is going to be critical. I would also be a little concerned if the Fed did something like a 50 basis point cut right off the bat. And again, there's a lot of conjecture about that some people believe that they are going to cut by 50 basis point. It's called front loading some of the cuts, right? A little shock to the system. I think the problem, though, with a 50 basis point cut, to me, it would be a signal that there's a problem, an economic issue. And talking about an economic issue, okay, I think for that, I want to go over to oil for a second while talking about the Fed, because oil, okay, to me, and oil, had some really strong sell side activity the last couple of weeks, right? It's on a bid back late in the week, but this looks like it's going to be faded. Now you got to realize the amount of geopolitical pressure, okay, oil should have on it right now, and yet it's still seeing huge sell side activity. So stop right there. Oil looks like we're going into some type of a recession. Okay. Obviously, Chinese markets have a lot to do with that. China is for the most part, in what is probably a very deep and cutting recession. And that's, one of the reasons there's pressure to the downside on oil. But I would believe that this is also going to impede upon economic progress here in the U.S. Oil selling off to this degree, though, is definitely a concern. And I believe that the Fed is probably going to be, considering some of the commodity products as well. So am I really torn between a 25 and 50 basis point cut? I'm not. I think it's going to be a 25 basis point cut, because at 50 basis points, I think it actually, again, it calls into concern. But the forward guidance, it's once again, everybody expects the 25 basis points. The forward guidance, that is Jerome Powell and his speech after that cut, that part's going to be critical, because he's going to actually lay down, okay, ultimately future cuts. That's what the marketplace wants to hear. All right, onward and upward. Let's just get through the Fed, because this week when we start talking about the Fed, things will get a little wild. There's quite a bump in volatility for this one. Okay, if you look how the week starts, so the week's actually going to start September 16th. Obviously, it's a Monday. Tuesday, we're at about a 13.6 vol, basically like a 14.8 vol, and then it jumps to about an 18 vol. So obviously this week is loaded up, but on the latter portion of the week. So we're backloading the volatility on the week. Speaking of volatility, all right, everybody's favorite, little volatility indicator would be the VIX, and the VIX has definitely come down quite substantially. Right, so the VIX has actually collapsed right back down to some degree, but let's not get ahead of ourselves, because the VIX just cruised back down to basically even north of where it was before it spiked the last time. Again, I'm not a big advocate of VIX. I make that well known. I look much more at things like VVIX and skew, and I do want to actually bring those to your attention. The VVIX, the volatility index, basically is screaming right now. Okay, do not put away, okay, your helmets just yet. So we actually have still a very amplified VVIX. When things are calm, when things are cool and collected, you're in the 90s, okay, you're in the 80s. We're still a 101, 102 VVIX. The VVIX is the volatility index. It basically indicates who's hedging and who's not. And when the VVIX is still at 100, and again, it's the volatility of the options in the VIX itself. And those VIX options are used by big firms to mitigate risk. And when you start thinking about like, oh, it's a 102 VVIX, it basically means that the professionals in the industry are still hanging on to a substantial amount of hedges, which means, as I said, don't put your helmet away just yet. Next, we actually have skew. Now, skew is calculated here at the end of the day, but if you want to take a quick glance at skew, and it's easier to put this in like a line chart, skew is upticked quite readily throughout the course of the week. This is also indicative of out of the money puts being purchased as hedges. So when I talk about volatility, okay, all I'm basically going to tell you about volatility is it's kind of a check, if you will, of what is going on kind of on the professional side of trade, where they're like, look, they're not relinquishing hedges. That doesn't mean that we're going to tank, but it doesn't help either. It doesn't mean that, we're absolutely going to tank. Basically, what I'm implying by looking at that is that the professional world, they don't believe risk has subsided. Neither should you. All right. Last thing I want to mention over here is risk reward. Okay, and risk reward. Okay, I am fully aware that we are butting up to all-time highs in the marketplace. In fact, for this, I'll cruise over to the spiders. I'm very aware that we're right up against all-time highs, but I would still, okay, make the argument all day long. There is absolutely upside potential. There's no question. We're going into another week that has a $100 expected move. Okay, but the downside risks are still very, very significant at this point in time. I mean, we've come through quite a bit of volatility in the last, few weeks, few months, if you will. Everything from seeing a precipitous drop, obviously, all the way back on August 5th to, 2 weeks ago with some wild volatility to the downside. Here we are, bid right back up. This marketplace, okay, and again, strictly from my point of view, is in fact likely to hit through all-time highs. Look, from a sheer probability perspective, chicken's done, right? We're going to hit the all-time high inside of the S&Ps. But I'll still make that argument. That downside risk is critically large. And look, if you're going to be bullish, it's fine. Spread the risk. Use something that's defined risk. In taking downside positions, you can definitely use spreads because you want to mitigate some of the volatility exposure to some degree. Because vol is still, I mean, look, we're looking at an all-time high in the S&Ps. Volatility really hasn't subsided all that much. So this is going to be a week coming in. This is going to be some high impact, some fairly wild trade in the latter portion of the week as the world starts to reposition around the idea of the Federal Reserve starting to pump liquidity once again into this marketplace. All right. As we already kind of discussed in here, well, expected move, you're looking at about $100 anticipation of movement this week, obviously either higher or lower. Okay, I will say this in the in the last 2 weeks, we've shattered again those expected moves by such a wide margin. Okay, again, kind of keep your hands and feet inside of the vehicle at all times. This week may start off a little slow and it'll pick up because people are going to be what? They're going to be hedging and gearing up before this Fed announcement, but the latter portion of the week, this is likely to be one rockin' marketplace. Thanks everybody for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.